So firstly, I wanted to thank Matthew for setting up these events. The microcap scene is very tight-knit. I feel like everyone knows each other. So it's good to get everyone in the same room here, chatting about ideas, giving different scuttlebutt on different companies and different things going on in the sector. So big kudos to you for putting these together and getting everybody in the same room. So my name is Nick Cortellucci. I founded a firm called Atrium Research about 3 years ago with my partner, Ben. And the best way to maybe describe what we do would be with an example. So with you guys being microcap investors, I'm sure you've been in the situation where you're trying to research a company to add to your portfolio, and you can't really find a lot of information out there. There's no analyst coverage. There's not really much research online on Twitter or LinkedIn or co.ca or places like that. And the banks aren't covering it because this is a microcap. They aren't raising a lot of money. They might be small, they might be liquid. So that's kind of where Atrium steps in, and we use the company-sponsored research model to produce content on some of these companies. So firstly, getting into what is sponsored research. So the way we look at sponsored research is a way to use equity research as a marketing tool for some of these companies to get their story and the thesis behind them out to an audience of investors all over the globe. So starting with what are the problems with the existing model with sell-side research. So myself and my partner Ben and the other members of our team, we came from the sell side, so we kind of speak from experience on this. So with a lot of these companies, they're only going to get research from a Beacon or a Cormark or one of these boutique banks is if they're doing a large equity financing or they're doing M&A or sometimes debt. So there needs to be a payday for these investment banks to make the research worthwhile for them. And with a lot of the best companies out there, like the ones that are here today, BQE and Amerigo, they aren't raising money. So there's no incentive for these investment banks to cover them. That's where Atrium steps in, where we can provide that same style of research content, but it's paid for directly by the issuer. The second point here, research departments are downsizing, the research quality is diminishing. We're just seeing some of these investment banks acquire each other. Some of them are shutting down, and overall, there's just less analysts in the space covering microcaps. And lastly, sell side is focusing on the institutional investors, leaving their retail shareholders in the dark. With us, we're targeting the entire cap table. The research is open sourced. Anybody can go out there and download the reports for free. So what is sponsored research? A couple points here. CSR, we produce a product that's extremely similar to the sell-side research in the way it looks and it feels. We have an investment thesis, valuation, a model, just like the sell-side. It's pretty indistinguishable the way that we do it. We provide estimates and commentary on the companies that you guys might be shareholders in or you're researching. And typically these are companies not being covered by the brokerages. And the research is open source, so anybody can go download our research on Twitter, LinkedIn, co.ca, but also our email list, our website, or even the traditional channels like Bloomberg and CapIQ, where the institutions go to download their research. And then lastly, implied by the name CSR, company-sponsored research, it's paid for directly by the issuer, meaning that it's reliable and it's consistent as we're contractually obliged to provide this research. So some of the benefits of CSR for investors. Firstly being the professional analysis. So myself and the members of our team, most of us came from the sell side. We have a background in doing this type of equity research on small caps and microcap companies. So you know that the insights are high quality and they're coming from a legitimate source. Secondly, analyst estimates. So for you guys that own shares in microcap companies, it's always great to have an estimate out there for what the next quarter is going to look like, what the next year is going to look like from a revenue, earnings, EBITDA perspective, so you can corroborate with our analysis with your own, and you know that management is taking a look at some of these estimates as well to make sure that we're in line. And lastly, accessible service. So CSR is open sourced, as I mentioned, so you can get the research on whatever medium you choose. And then what are some of the benefits for companies? Firstly being, we reach the entire cap table, so retail and institutional. The sell side, they're really focusing on those institutional investors that can move the needle. But with us, we're really focusing on those microcaps, so the retail investor is a key piece of that. Global distribution, so for a company to go market to institutions in London or Zurich, it costs a lot of money, time, flights, hotels, and so on. But with us, we can tap into those global investors using our research. And lastly, increased liquidity. public companies that have analyst coverage are always more liquid than companies that don't, just because there's estimates, there's target prices, and there's insights and commentary on the company. It decreases the information gap and increases the awareness on the company, and that obviously benefits the company as the liquidity improves. So the importance of estimates. So I think this is kind of one of the main points to harp on here. Having estimates out on some of these microcap companies for revenue and EBITDA and so on is a major value add. Firstly being because it anchors expectations. So you guys know going into the next quarter, what does Atrium think the numbers are going to look like from the different KPIs for each company, so that you're not expecting too much or not expecting too little. Obviously the company can outperform or underperform that. And then secondly here, it makes valuation easy for you guys. So being a microcap investor, you want to be looking at forward-looking estimates for, EV to EBITDA or price to earnings. With our analysis, you can get those estimates and then do that valuation analysis on a forward-looking basis rather than a backwards-looking basis if you didn't have that analyst coverage. And then screening, that bleeds into the next point of screening, where if you're screening for companies that are growing 20% revenue next year, or they're trading at a certain multiple of next year's earnings, these microcaps aren't going to show up on those screens because they don't have estimates. That's where Atrium steps in, providing those estimates, making sure that those companies show up in the screens. And lastly being long-term outlook. So we take about a 3 to 5 year outlook on our companies that's rooted in fundamentals, so that you know that we're not too short-sighted. We're trying to look at what these companies are going to look like in the future. So here are a couple charts that kind of say the same thing, but the main point is that research can help improve liquidity. Stocks that have analyst coverage are more liquid than stocks that don't. That's because there's estimates, there's target prices, there's insights. When that press release comes out at 7 a.m. in the morning, the analyst is out there with their commentary a couple hours later saying, what does it mean to the target price? What does it mean for the model? And that overall improves liquidity, which helps out investors because, as you know, with a lot of these microcaps, it's hard to build a position in. And that helps companies because you're going to trade at a higher multiple if your stock's more liquid. So why read our research? 4 main points here. Firstly, finding new ideas. So we cover about 40 different companies today. We have a bunch of initiations in the hopper right now. So you're consistently getting new ideas in your inbox from reputable analysts. Secondly, estimates on companies that you own. As I mentioned, you can anchor that expectation for the next couple quarters, the next couple years in our analysis. Thematic research. So we do research on different themes in different industries that are intriguing to us. You guys might know our series on small cap takeouts, where we try to predict a watch list of companies that we think could get acquired over the next couple of years. So that's an important and relevant one that we do, but we've also done stuff on the defense sector. We've done things on infrastructure, lots of different themes that we write on to distribute to our investors. And then lastly, hear directly from management in interviews. A lot of you are probably familiar with this, but it's always great to hear directly from management how they tell the story, how they interpret a press release directly on our YouTube channel, rather than just reading the press release. It goes a step further. So debunking the myths on sponsored research. So when I say sponsored research, probably a couple, red lights come up in your head, and we'll try to put those to bed here. Firstly, the main one, CSR is bias. The first thing here, CSR firms retain full editorial control. So effectively, if somebody reports a bad quarter, we're going to call it like it is. We're going to stick to the facts, and we have the power to do so. The issuers never get to see the target price until we publish the report, so that you can ensure that this valuation analysis is done by us. It is a price target that we believe in, and we're not being pushed one way or another. We use the same business model as auditors and debt ratings agencies. Auditors are paid for a service. Debt ratings agencies are paid for a service. We do the exact same thing as them. And lastly, sell side is also biased. The quote that we always say is, all research is paid for one way or another. The sell side being investment banking fees. Us, it's directly paid for by the issuer. And with those investment banking fees, they're actually incentivized to push up the stock price, and so that they can go from a $10 million financing to a 20 to a 30 by increasing the stock price. And a lot of the time, these investment banks are getting broker warrants in the companies that they're writing research on. So they're actually incentivized to increase the price, so those warrants are worth money. And we don't have those issues as we're paid in cash. The next one, CSR is promotional. couple points here. Institutional analysts and quality. I encourage you to check out our research and see the quality of the work that we put out. There might be some bad apples in the space, but I don't think we are one of them. Research standards and fundamental analysis. Pretty standard things here that back our analysis. We're sticking to the facts. We're regulated by the TSX and the TSXV here in Canada, so we can't be too promotional. We can't say, oh, this stock is going to the moon. We have to stick to the facts. We have to stick to legitimate, reasonable analysis. And lastly, our reputation's on the line. So we started this firm about 3 years ago. We're trying to be around for the long term. So we're not trying to be promotional, work with some sketchy companies in the short term. We're trying to work with businesses over the long term that can deliver value for shareholders. Investors don't trust CSR. As I mentioned, all research is paid one way or another. MiFID II is a regulation that happened overseas about 5 years ago that really popularized CSR to a point where about 30% of the research happening in the UK and Europe is actually sponsored now. And that trend is starting to come over to North America over the last couple of years, especially with what we're doing. As I mentioned, institutional analysts, and then that changing sentiment. We're doing things like this. We're educating the market on why sponsored research is equivalent, if not better, than the broker research. And I think over time, it's going to become more and more normalized. And then the last misconception here is CSR is only used by desperate companies. So we put together 12 companies here, all multi-billion-dollar companies: Rolls-Royce, British American Tobacco, Newmont, Agnico, NatWest, Delta Airlines, and so on. All these companies pay for research. So they see value in the product, and they already have 10 to 15 analysts covering them from the sell side, but they still pay for research to broaden out that distribution and reach a new crowd. So then getting into Atrium Research, what we do in particular, 3 main pillars that we kind of guide ourselves on: the quality of the work that we put out, the analysis that we do using well-respected analysts, as well as the distribution channels we use. Our team, there's 4 of us full-time right now. Ben and I founded the company about 3 years ago. We came from the sell side, so we know this world. And then we also have Luca Perna, who's a research associate, and then Riley, who just started in January as another analyst covering mining. So what we're looking for in companies, these are all pretty standard things, I'd say, for basic fundamental analysis, but revenue growth, profitability or close to it, clean balance sheet, incentivized management, and the last or most important one, underfollowed or misunderstood. So with microcaps, you're obviously not going to be able to have a perfect check mark on everything, but we try to check off as many as we can. And there are hair on some things, but you can get past it with valuation. So the difference we've made for corporates here, sorry, the chart isn't showing up properly, but for corporates here, the volume has increased about 230% on average with our clients comparing prior to Atrium versus currently. So you're knowing that people actually read this research, they end up trading the stocks because of the estimates and the analysis we do. And then for investors in the crowd, our initiation reports are up 136% on average. So if you bought them all, you'd be up well over a double. So we're not just working with any company out there. We're highly selective. We're making sure that these companies are executing. They have catalysts and they're high quality businesses, and it's worked out pretty well. So going into a couple case studies, we chose a few of our favorite companies here. They might be presenting here today. Firstly, BQE Water. We started covering the name when it was around $30, $35. And you can see as the company executed, we acted as that megaphone to them when they had their strong quarters, new contracts and whatnot. We were out there, putting out our research notes and updating our model, and that's worked out. The stock has reached over highs of $70, and then the volume has also improved pretty drastically. And then the second one also presenting here today is Amerigo. Great chart here, very steady. We started covering the stock around $2, and the company's really executed from an operational perspective as well as from a capital return perspective. So the stock recently traded around $5 in highs of over $6. So both of those companies are here today, and they will present. I'll let them give the pitch, but I do think they are great companies that you should be following and using our research as a resource. And then getting into some of our topics for this year, and I wanted to bring some new ideas that you guys might have not seen yet. Firstly being Clean Tech Industries. So this is a company that does clean energy equipment for the oil and gas sector. So think lighting solutions as well as wastewater equipment. This company has had a pretty steady past, but over 2025, the growth really accelerated. They grew about 23% in 2025, and that's going to accelerate to almost 50% in 2026 based on a new contract that they signed for 60 of their lighting units out in the Middle East, really boosting the growth. This is a company that has extremely high margins, over 30% EBITDA margins, which is the top of its peer group. It also has a tax loss pool of over $70 million. So you know that EBITDA is going to convert to free cash flow, and it makes for a good acquisition target if somebody wants to take advantage of that. And just on valuation, it's a very cheap company in our view. It trades at about 4 times 2026 EBITDA or 3.4 times 2027, which is a large discount to both energy service peers as well as clean tech peers. So that all comes together to a target price of $1.10. So you can check out our research on this one. We have a full initiation report. We also just did an interview with management. And then the second and final one I wanted to bring to you guys, some of you may know it, is NTG Clarity Networks. It's been a large multi-bagger over the last couple of years, but we do think that there's still legs for it to rebound here. So what the company does, it provides IT solutions to large enterprises in Saudi Arabia and mostly around the Middle East. And this is a company that has had exceptional growth over the last few years, growing at over a 60% CAGR. We think it's going to be around 20% going forward. They have a good backlog, and they're really taking advantage of Saudi Arabia's Vision 2030 goals, where they're trying to diversify their economy away from oil and gas. And why the stock is pulled back, it's down around 70% off its highs, is because of the margins that have as well pulled back from recent highs as they've started to expand their workforce, hire more people so that they can service this new demand that they're getting from the top line growth. And we think the margins have hit a bottom in the last quarter, and we think that'll improve going forward. And then just on valuation, extremely cheap, 3 times 2026 EBITDA or 2 times 2027, which is very cheap for any technology company. Nevertheless, one that's grown at 60% over the last few years and 20% going forward. So we think that despite the pullback, it's a great opportunity to buy a high growth company at a discounted valuation. So we have a $2.50 per share target price on that one. And then just as I wrap up here, I wanted to flash some of our coverage on the diversified side. These are companies that are under my responsibility. Some of them I've also presented here, being Rubicon and Canaro, maybe some of the others. But if you are a shareholder in these or have these on your watch list, you can check them out on our website, or you can come speak to me directly after this and we can chat about them. And then also wanted to flash our mining coverage. This is supported by my partner Ben, as well as our second analyst Riley. And again, please feel free to check out some of these companies. A lot of them have performed really well over the last couple of years, and I can probably speak to some of them at a high level. So feel free to come up and chat. So that's the presentation. If you guys want to read more about us, the website is atriumresearch.ca. You could subscribe on there, but you can also get our research on Twitter, LinkedIn, co.ca, wherever you get your investment research content. We're up on there. So feel free to check it out. And then again, thanks, Matthew, for having me here today.